Have you ever wondered why some people effortlessly become rich while you're hustling twice as hard but still stuck living paycheck to paycheck? The harsh truth is, wealthy people follow a secret financial playbook, and today I'm ripping it wide open. I'll expose the 7 toxic assets secretly destroying your finances, keeping you locked in the endless rat race. These aren't just bad investments, they're money-draining traps disguised as status symbols and signs of success. If you're serious about escaping financial mediocrity, pay close attention. This could change everything. Number 1. Timeshares, the glamorous money pit. On the surface, timeshares look like the ultimate dream. A guaranteed vacation spot every year, luxurious amenities, and an affordable ownership opportunity. But behind the glossy brochures and persuasive sales pitches lies one of the worst financial traps you could fall into. Here's the brutal truth. Timeshares are not real investments. They don't appreciate in value. In fact, they lose value the second you sign the contract. Unlike real estate, you can't build equity with a timeshare. You're essentially paying up front for years of vacations at a resort you might not even want to visit later, and that's just the beginning. According to the American Resort Development Association, the average cost of a timeshare is around $24,000, not including annual maintenance fees, which typically increase every year. Even worse, when you want out, you realize the resale market is flooded. Most timeshares are nearly impossible to sell and often go for just pennies on the dollar. Many owners end up paying someone else just to take it off their hands. Warren Buffett's investment principle is simple. Only buy something that you'd be perfectly happy to hold if the market shut down for 10 years. Timeshares fail this test miserably. You're locked into decades of payments with almost zero flexibility or financial upside. Instead of sinking money into a depreciating vacation promise, smart investors focus on assets that grow over time: real estate, index funds, dividend stocks. Vacation when you want, where you want, without being shackled to a contract that drains your wallet. Before you sign that tempting timeshare offer, ask yourself, is this building my wealth or just draining it? Number 2. Luxury cars, the silent wealth killers. There's a reason why Warren Buffett still drives a modest car despite being worth over $100 billion. He understands a fundamental truth. Luxury cars are wealth destroyers in disguise. The moment you drive a brand new luxury car off the lot, it loses 10% to 20% of its value instantly. According to Kelley Blue Book, most vehicles depreciate about 60% within the first 5 years. That shiny $80,000 luxury sedan, it could be worth less than $35,000 before you've even paid it off. But the real damage goes beyond just depreciation. Luxury cars come with sky-high insurance premiums, costly maintenance, expensive repairs, and higher taxes. You're not just buying a car, you're signing up for a relentless financial bleed that can quietly siphon away hundreds of thousands of dollars over your lifetime. The brutal irony? Many people buy luxury cars to project success, but in doing so, they sabotage their long-term financial freedom. True wealth isn't about looking rich, it's about being rich. Buffett famously said, "If you buy things you don't need, soon you will have to sell things you need." Smart investors understand that cars are a utility, not an investment. Instead of pouring money into rapidly depreciating assets, they prioritize growing their wealth through appreciating investments like stocks, real estate, or businesses. Ask yourself, are you buying a car to serve your life or to impress people who won't even remember you in a year? Every dollar wasted on luxury for show is a dollar stolen from your future freedom. If you're finding this eye-opening, make sure you hit the subscribe button now. We dive deep into the strategies that actually build real wealth and expose the traps that keep people stuck in the rat race. Don't miss out on the information that could change your financial future. Subscribe and stay one step ahead. Number 3. Whole life insurance, the hidden wealth trap. At first glance, whole life insurance sounds like a smart move. Life coverage plus a built-in savings account that grows over time, but don't be fooled. Whole life insurance is one of the most expensive financial mistakes you can make. Unlike term life insurance, which gives you pure protection for a fraction of the cost, whole life policies mix insurance with investment in a way that benefits the insurer far more than it benefits you. Studies show that the average return on a whole life policy's cash value is barely 1% to 2% per year. And that's before fees and expenses. Meanwhile, the insurance company enjoys guaranteed profits off your money. The problem runs even deeper. Whole life insurance locks you into high premiums for decades. If you miss payments, you could lose both your coverage and the cash value you thought was guaranteed. And if you ever want to access your cash value, you often have to borrow it, paying interest on your own money. Warren Buffett warns investors to be wary of products they don't fully understand, especially when the people selling them make hefty commissions. Whole life insurance fits that description perfectly. Agents push these policies hard because they earn some of the highest commissions in the financial industry, sometimes 80% to 100% of your first-year premium. If you want true protection, a simple term life insurance policy combined with smart investing will build real wealth at a fraction of the cost. Remember, insurance is for protection, not profit. Don't fall for the sales pitch that quietly drains your financial future. Before signing up for any investment disguised as insurance, ask yourself who really wins here, me or the insurance company. Number 4, actively managed mutual funds, the fee vampires. You work hard for your money, bara is dir anhai. But if you're investing in actively managed mutual funds, you might be handing a huge chunk of it to someone else without even realizing it. Actively managed mutual funds are sold as the smarter, more hands-on way to grow your wealth. But the numbers paint a harsh reality. Over 85% of actively managed funds underperform the S&P 500 over a 10-year period, according to SPIVA, S&P Indices versus Active. And while your returns struggle to beat the market, the fund managers still get paid, whether you win or lose. High management fees are the silent killers. A typical actively managed fund charges around 1% to 2% annually. That might not sound like much, but over time, it's devastating. According to Vanguard, a 1% fee can erode up to 28% of your investment returns over 30 years. Imagine working decades to build your nest egg, only to lose a quarter of it to unnecessary fees. Warren Buffett himself recommends low-cost index funds for most investors. His famous bet against hedge funds, where a simple S&P 500 index fund crushed highly paid fund managers, proves that you don't need to pay Wall Street a fortune to grow your wealth. If you're serious about building financial freedom, focus on minimizing costs. Every dollar you save in fees stays in your pocket, compounding and working for you, not for a fund manager's next vacation home. Before investing another dime in a flashy, expert-managed fund, ask yourself, am I growing my wealth or just enriching someone else's? Number 5, penny stocks and crypto hype, false promises of overnight wealth. The dream of turning a few $100s into millions overnight is intoxicating. That's exactly why penny stocks and hype-driven cryptocurrencies are some of the most dangerous traps for people chasing quick riches. Penny stocks, shares priced under $5, are often sold as ground floor opportunities. In reality, they're incredibly volatile, thinly traded, and highly susceptible to manipulation. According to the SEC, most penny stocks either fail entirely or deliver devastating losses. Scams like pump-and-dump schemes prey on hopeful investors, leaving them holding worthless shares while insiders walk away rich. Cryptocurrency, while revolutionary in some aspects, has also created a frenzy of speculation. In 2021 alone, over 2,000 new cryptocurrencies were launched, many of which turned out to be scams or collapsed entirely. While Bitcoin and a few others have real staying power, chasing the next moonshot coin often ends in financial disaster. Warren Buffett has always warned against speculation masquerading as investing. He famously called Bitcoin rat poison squared, not because technology itself is bad, but because blind speculation is a guaranteed path to wealth destruction. Real wealth is built patiently through disciplined investments and proven assets over time. Chasing get-rich-quick opportunities almost always leads to getting poor quicker. Before you put your hard-earned money into the latest hot stock or flashy new crypto coin, ask yourself, am I investing based on value or gambling based on hope and hype? Number 6, extended warranties and protection plans, fear-based spending. At the checkout counter, it sounds so reasonable, like for just a little extra, you can protect your purchase. But extended warranties and protection plans are rarely about protecting you, they're about protecting the seller's profits. Retailers make huge margins on these add-ons. In fact, Consumer Reports found that stores often keep 50% or more of the price you pay for an extended warranty. Why? Because statistically, most people never use them, and when they do, claims are often denied or complicated by hidden fine print. The fear of what if something goes wrong is a powerful emotional trigger. Companies know this. They exploit it to get you to spend extra money you probably don't need to spend. Most products today, especially electronics and appliances, are designed to last well past their standard manufacturer's warranty. If something is truly defective, it usually shows up within the first year, which is already covered. Warren Buffett teaches that one of the most important financial skills is emotional discipline, not letting fear dictate your money decisions. Extended warranties are fear-packaged and sold at a premium. Over a lifetime, those small add-on costs can quietly drain thousands of dollars from your wealth. Smart investors self-insure. Instead of paying for dozens of unnecessary warranties, they build an emergency fund that can easily cover unexpected repairs without handing free money to retailers. Next time someone offers you an extended warranty, ask yourself, am I protecting my future or just padding someone else's profits? Number 7, collectibles and speculative assets, betting your future on hope. It's easy to get swept up in the excitement. Rare baseball cards, limited edition sneakers, vintage cars, even Beanie Babies once promised fortunes. But here's the harsh truth. Collectibles are not reliable investments. They're speculative bets, often fueled by nostalgia and hype, not real economic value. Markets for collectibles are highly illiquid and unpredictable. A collector's item is only worth what someone else is willing to pay at a given moment. And that demand can disappear overnight. During the Beanie Babies craze of the 1990s, some toys sold for thousands of dollars. Today, most are worthless. The same pattern repeats itself across fads, from NFTs to rare coins. Even when collectibles do appreciate, selling them at a high price isn't guaranteed. Transaction costs, taxes, storage, and insurance quietly eat into any potential profits. Worse, if you ever need quick cash, finding a buyer at the right price can be next to impossible. Warren Buffett's timeless advice rings loud here. Never invest in a business you cannot understand. Most people diving into collectibles don't fully understand the markets they're entering. They're gambling on emotion, not fundamentals. Building real, lasting wealth requires discipline, not chasing the latest trend. It means investing in assets that produce cash flow, appreciate steadily, and can withstand economic storms, not tying up money in objects whose value is based on hope and hype. Before you sink your savings into the next can't-miss collectible craze, ask yourself, am I building an asset or just buying a dream? Escape the traps. Build real wealth. If you've recognized yourself falling into any of these 7 traps, you're not alone. And it's not too late to change course. The hard truth is financial freedom isn't about working harder. It's about making smarter choices. The wealthy don't just know how to make money. They know exactly where not to lose it. They avoid money-draining assets disguised as success symbols. They refuse to throw their future away chasing hype, fear, or false promises. Warren Buffett built his empire not by making flashy moves, but by sticking to simple, timeless principles. Protect your capital, invest in what you understand, and never mistake speculation for investment. The question now is, will you keep pouring your hard-earned money into status traps and empty promises? Or will you break free and start building real, lasting wealth? Every dollar you save from these toxic assets is a dollar that can work for you, grow for you, and eventually buy you the one thing money can truly offer: freedom. Your future is built today, one smart decision at a time. Choose wisely. If you're serious about protecting your money and building real wealth, this is just the beginning. Hit the subscribe button right now, because every week we break down the hidden traps, reveal smarter strategies, and bring you the financial playbook the wealthy don't want you to know. Don't leave your future to chance. Subscribe today. On so and take control of your financial destiny.